Thank you,
Yep.
everybody, for attending.
What the agenda this evening is to touch base for first-time home buyers and get some good information on mortgage qualification, mortgage products, documentation, pricing and costs, and the mortgage process. We truly care and value our customers at Univest, and we're just so happy that you're here to join us this evening and learn a little bit more about what we're looking for when you're applying for a loan, what we're looking for in qualifying. So the first thing I'm going to talk about is mortgage qualification. So with that, there is 5 C's of credit. And what that means, it's the characteristics that help us at Univest determine the credit worthiness and risk of a potential borrower. So the breakdown with those 5 C's, as you see, is going to be first the credit, the reputation or credit history of your, your credit. Capacity is going to be that ability to repay the loan, meaning by comparing income against reoccurring debts, also known as debt to income ratio, your DTI. And that's fun. We're going to have a nice little exercise so we can show you how we formulate that. Capital is going to be your net worth with the value of assets that you have minus your current liabilities. Collateral, we're looking at assets that can be used to pay debt if you fail to make your payments, and your overall character, outside circumstances that may affect borrowers' ability to repay. Our goal is to make sure that you understand the whole flow of a loan application and the whole process. We truly care, and I know Mike and I do. We love first-time home buyers and anybody looking to borrow money. We want to make sure that you understand the whole process from start to finish, and that you understand everything, because by the time you get to settlement, it should be a happy occasion. There really shouldn't be any surprises. We don't want surprises, and we want to make sure you truly understand how the whole loan works and you're comfortable with it. Because then we know we did our job. We did the best we could for you. You're happy, you're getting this home, and everybody's excited. So the debt to income ratio, you probably heard the acronym DTI. That is your total monthly debt divided into your total monthly income. So this is a nice quick little exercise to look at your total debts and how we formulate that debt to income. So as you can see on the left here, that mortgage payment, it's going to be a proposed mortgage payment for you, meaning it's going to be your principal and interest to pay the loan back. It's going to be the taxes and insurance as part of the payment, and you might incur a homeowners association fee. So we did add $100 there. That could be for if you're purchasing a townhouse or a condo. Sometimes I've seen it in single family homes where they have a homeowners association fee, and like for trash, snow removal and whatnot. So we put that into part of the payment. And we also put in as far as any of your monthly debts, as far as credit cards and other debts. So we're just going to use $250 there. So when you're adding all these together, your total monthly proposed payment, your credit cards, we're going to show a total monthly debt of $2,000 for that monthly debt. Then we're going to go over to the income for salary and wages, and we're going to use just a simplified $60,000 yearly salary. We're going to take that divided by 12, and that's how you come up with that $5,000, and that gives you that $2,000 a month in debt divided into your total monthly income of $5,000. And that's going to show a debt to income of 40%, which is really good. People ask, like, well, where do you want to fall? I mean, it depends. It depends on every borrower, their different situations. Some have more monthly debts, some make more income. I would say 45% and under is really good. We can go up to 50. It's not always going to happen, but it can happen, and we can go up to 50%, but 40% in this little exercise, that's really good. So when there's so many mortgage products that we offer at Univest. I mean, I love working at Univest, and everything that we have to offer. It's phenomenal. There's so much. We don't want to overwhelm you this evening. We want to talk more about some of the more basic loans that we do, but I just want to touch on that we go from a traditional mortgage to an FHA loan to a USDA. I mean, we have great grant programs, First Front Door, PHFA. We have a KFIT that will help for closing costs. There's so many options at Univest that when we look at a borrower and we have that initial conversation of what you're looking to achieve, and we run credit and it's like a step-by-step process, we figure out what is going to be the best mortgage product for you, and we're going to give you options. So we're going to start off with the normal, traditional, conventional mortgage. It simply means that it meets the requirements of Fannie Mae and Freddie Mac, our investors. These are best for individuals who want to purchase a primary, secondary residence, or an investment property. The rate type is fixed. Maximum term is going to be 30 years. Maximum LTV is 97%. So what that means is you can put as little as 3% down, which is really good for first-time home buyers. That is our Home Ready and Home Possible. And we'll take a look at that and see if that's a good fit for you. If not, that's okay. There's other products. And again, in this conventional loan, we can even do 5%, 10%, 15%, lots of options. It's really going to be what's going to fit you best as far as, looking at your credit score again, your assets, gift money, just so many moving pieces, but we're here to help you and guide you and put you in the right program. So don't worry. And we're going to move forward, and I'm going to talk a little bit about our government loans. So there's a couple here that I'd like to talk about. I'll start with the FHA loan. This is best for customers who are looking to purchase a newer first home and have limited funds for a down payment. I love this loan. I put a lot of first-time home buyers in this loan. The down payment requirement is 3.5%. You can get 6%, up to 6% in seller's assist. The rate type, we offer fixed and adjustable rates. I would be honest, most people pick the fixed. Maximum term, you're going to see that across the board here, 30 years. And that maximum LTV is 96.5. So that, again, meaning you have 3.5% invested that you're going to put down if you go FHA. The maximum loan amount, that's going to vary based on the county limits, but we don't expect you to know that. We're going to help, again, guide you, put you in the right product. And if we're going to go FHA, we're going to make sure that you fit those county limits. So no reason to panic there. Then I'm going to talk a little bit about Royal Housing. So this one is best for customers wanting to purchase a home in a designated Royal area. This is defined by the USDA and meets limits set by the USDA. So I've had questions say, well, how am I going to know this house is USDA eligible? And that's a perfectly great question to ask. It's our job here at Univest to help with that. So when we're thinking this is a good program for you and you're out shopping for a home, you can quickly send us a message and let us know what property you're looking at, and we'll be able to tell you if it's USDA eligible. This is terrific with that it offers maximum LTV of 100%, meaning no money down. And the maximum loan amount is that $647,200, and again, 30-year term. So this loan is tremendous. I've done a couple of these. Like the first-time home buyers love it. They don't need to bring a lot of money to closing. We just need to make sure you fit this product. It does have household income qualifications, and all we do is, we piece everything together and see if you can fall within this one. But it's a really great loan. The next one that I'll go over is a favorite of mine. I really love that we offer loans for the veterans of the U.S. military who are looking to purchase and refinance their primary home. This is primarily, it's for veterans. 100% maximum LTV. Again, no money down. How great is that? And the maximum loan amount, there's no limit with full entitlement. But so this is a loan for veterans, and they will be giving us documentation, and we will be able to tell them, and get them qualified using their full entitlement. So if you're not a veteran, unfortunately, we can't put you in this program, but for the veterans, we will help them. We'll need your DD 214. We'll, go over full entitlement, and we'll try to get you in this loan. This is a great, great product. And then I'm going to pass it over to Mike, and he's going to start with this construction of perm loans. And these are excellent too. These are ones for people looking to build their own home. Mike, if you want to jump in.
Yes, thank you, Susan. I appreciate everything. And just to reiterate, we do have a Q&A chat box for anybody who has questions. Feel free to type in the question, and we'll circle back at the end of the presentation and answer any questions that people have. So just to continue on here, so another mortgage product that we offer, which is very unique to the industry, because not every institution does these type of loans, is our construction to perm loans. What these entail is basically it's best for an individual who's looking to build their own home with a custom builder. This is somebody who wants to buy a piece of land or buy a property that has a house on it, tear it down, and build their own custom home. This is not for somebody who wants to buy a new construction home and is just doing a loan. We're going to do a loan on the end product, like somebody's, Toll Brothers is building the home, and we're going to do a loan on when the house is finished. We do offer that as well, but that is different than a construction to perm loan. Construction to perm, somebody wants to buy a piece of land, and we do land loans as well. If somebody wants to buy a piece of land and kind of get their ducks in a row before they build, we do offer that as well. So it comes in an adjustable rate mortgage, a 30-year term. We do up to 90% of the value. So we'll do up to 90%. We'll take the value of the land that you're going to pay. So give you an example: if you're going to pay $300,000 for the land, and it's going to be $700 or $700,000 to build, so that's $1 million combined. We'll do 90% of that, meaning we'll lend you $900,000 based on that. So we'll take the value of the land plus the cost to build, add those two together, and we can go up to 90% with a maximum loan amount of $3 million. If you want to jump to the next slide, please, Susan. So home equity loans, home equity loans are obviously a key part of the industry when it comes to people needing financing. So especially this comes into play, especially in a rising rate environment when somebody wants to consolidate debt, do home improvements, get money for tuition, but they already have a low fixed rate mortgage on their house at 3% from a couple years ago, and they really don't want to refinance and get out of that 3% to a higher rate now when they need $35,000, $40,000, $50,000 for whatever the case may be. So there's a home equity loan and a home equity line of credit. All right. So again, it's best for customers who have sufficient equity in their home and want to borrow against their home for items such as a car, debt consolidation, home improvements. I like to throw in tuition in there because a lot of people utilize it for tuition. Home equity loan is a fixed rate loan. It's a 15-year term. We'll go up to 85% of the value of the house, subtract out whatever first mortgage balance that they have, and that's how much you can borrow, and then maximum loan amount of $350,000. Usually the more popular ones on this type of product is a home equity line of credit. It's a variable rate with a fixed rate option. It's 25-year term, and you have 10 years to draw from it. So what that means is a home equity line of credit, if you want to borrow a $50,000 home equity line of credit, but you only end up using 20,000 of it, that means you still have the rest of it to use for the first 10 years. So it's great if you want to have this home equity line as an emergency in case, God forbid, something happens, you lose your job, or the car breaks down and you need to get a new car immediately. It's just there as an emergency reserve for you. So home equity line of credit is a very popular one. And again, we'll go up to 85% of the value of the house and a maximum loan amount of $350. Your payment's going to be variable because it's going to be depend on how much line you use. I always like to tell people, think of a home equity line of credit. It's like a credit card against your house. If you have a credit card with a $10,000 limit, but your balance is only $1,000, you still have obviously a significant amount of usage on your credit card, and your payment's going to vary on how much you use. So kind of think of it in that kind of aspect on a home equity line of credit. Okay, next slide, please. All right. So everyone says that the mortgage process is so daunting. Well, we're here to make it very easy for everybody. Susan and I have been doing this a long, long time. We know this, we realize that sometimes this is a borrower's first time ever going through this process. Sometimes it's a client who's done this 2 or 3 or 4 times over the years. So we treat everybody, and the whole Univest team treats everybody like it's their first time. Because things change, guidelines change constantly, documentation needs change constantly, and we do this for a living. So we know exactly what we're going to need. We walk you through the process. So documentation, I live by the 2-2-2 rule. So 2 years W-2s, 2 years tax returns, if applicable, and 2 pay stubs, 2 most recent pay stubs. A lot of this stuff is time sensitive. So when we say pay stubs, I can't just say to a client, I need your 2 pay stubs. Well, they might send me pay stubs from 6 months ago. Well, that doesn't work. They have to be your 2 most recent pay stubs within 30 days. It has to cover a 30-day period. So if you get paid weekly, I'm going to need 4 pay stubs. If you get paid bi-weekly or semi-monthly, I'm only going to need 2. So these are the kinds of things that we, as we're taking your application, we're talking to you, we're asking these kinds of questions. And again, your assets. So 2 months of bank statements. Okay, we need to cover a 60-day period of your bank statements. I can't stress this enough, and I know Susan's going to crack a smile when I say this. We need all pages of your bank statement, even if they're blank. Many bank statements, they'll say 4-page statement and page 4 is blank. We need page 4, because how do we know it's blank? So the best thing I can tell you to do is when you're sending over a bank statement, look at either the top corner or the bottom corner, and you'll say page 1 of 4, page 2 of 4. Just send all pages. That's crucial because we get it all the time. We get screenshots, cell phone pictures, and it doesn't have the borrower's name on it. There's no way to, if we can't tie it to being yours, we can't use it. So just as a rule of thumb, just know if it doesn't have your name and your address and your account number on it, we can't use it to verify. So 2 most recent asset statements with all pages. Obviously the purchase agreement. When you go under contract on a home, we need the agreement of sale. Either we can get that copy from you, we can get it from the real estate agent. That's pretty basic item to get. Proof of insurance. So when you buy a home, you're going to need to line up homeowners insurance before we go to closing. You don't have to pay for it in advance. It can be paid for at the settlement table, but you at least need to find out, you need to pick what agent you're going with, State Farm, Allstate, Univest. We do offer insurance services. And you just need to line up the policy and it'll be paid at closing. So we can't go to the closing table for a home purchase because you have to, if you're going to sign the paperwork that day and you're going to get handed the keys to the house, you have to have the home covered for, God forbid, a fire or loss or anything like that from that point forward. So it has to, the homeowners has to be lined up before, when we go to the closing table. Okay, so pricings and costs. So obviously interest rates. Interest rates are obviously probably the biggest question we get all the time, from clients. And a client will say, well, what is your interest rate? Well, I need to know exactly what you're looking to do, how I can help you, because I could talk to 15 different people and the interest rate is going to be different for all of them, because everyone's got different qualifying criteria, credit scores, debt to income ratios that Susan talked about earlier. All these different factors, how much you're borrowing against the value of the property. So like your loan to value, are you putting down 3%? Are you putting down 20%? All these different factors make up an interest rate. Interest rates are based on risk. How risky is it for the bank to lend the client the money? Is it riskier if somebody's only putting 3% down versus somebody who's putting 20% down? Sure it is. So all these different factors make up interest rates. There's no two people who are going to get the same exact interest rate unless they have the same exact criteria. Fees. So there's standard costs when you purchase a home. The title insurance that you'll see on their other costs, the title costs, standard, every state has their own standard title costs. So Pennsylvania has their own standard costs, New Jersey, so on and so forth. They're all regulated by the state. So it's not like a title company can just gouge you. These are fees and costs that are mandated to be in place. You can't buy a home without title insurance, okay? Univest has one flat fee that we charge on for every client, and it's probably if not the lowest in the industry, one of the lowest in the industry. It's $895 flat fee. So that's really all we charge. Every other fee that you have is going to be your standard cost. Your appraisal fee that pays for the appraiser to go out to the property to make sure the home is worth what you're buying it for. Like I said, your title insurance costs, transfer taxes. Transfer taxes are charges that are charged to both the buyer and the seller. That's the cost of doing business with the county and the state. That's how they make their revenue. So there's, and again, we offer a cost estimate, a full cost estimate to you. No obligation, no charge to do that. And then we walk you through what these charges are so you have a full understanding of everything. And then your annual percentage rate. So you have your interest rate, which is your monthly interest rate that you pay on the loan. You have what's called your annual percentage rate. Your annual percentage rate is always going to be higher. Usually is going to be slightly higher than your monthly interest rate because it includes finance charges at the time of closing on the transaction that are annualized over your loan. Okay. And I'm sure we'll get some questions on that. So the mortgage process. So when you're talking to a loan officer such as myself or Susan, we can do a pre-qualification. Pre-qualification is basically we just gather information from you, your basic information, name, address, social, date of birth. We do a credit check for a pre-qualification, and all your employment information. We can tell you basically how much you qualify for. This is really, we can do it without gathering documentation from you, as long as as long as you're giving us accurate information. I like to do this step and then have people send me their pay stubs and W-2s after I speak with them, just so I can stay ahead of the curve and make sure that there's nothing that's going to fall through the cracks. And 2 months from now you find a house and then you send me your pay stubs and you make half of what you told me you did. So I just like to cross my T's and dot my I's like that. The pre-approval is basically very similar to the pre-qualification. We gather all the documentation from you. We actually submit it to underwriting for full review. This is prior to you going under contract on a house. So you can actually be fully underwritten on a loan, knowing that an underwriter's reviewed everything. And now all you got to do is go find a property and get an agreement of sale. The application, so you can apply online on our websites, which is a very user-friendly application on our websites. Obviously, we can do face-to-face in person, or we can do over the phone. Any information that we're gathering for an application is very basic. It's nothing that you're not going to know. It's your general information, your employment history. If there's multiple people on the application, same thing. So it's not a daunting process by any means. So once you are under contract on a house and we gathered all your documentation from you, now we're ready to submit, and we have the agreement of sale. Now we're ready to submit your loan to basically our operations side. And the first step with that is it goes through our opening department. Our loan opening department orders the appraisal and the title work on the property. Okay, nothing that you as the buyer need to do. This is all done behind the scenes. We send out disclosures to you that are e-signed electronically. If you prefer, you can we can overnight them to you. You can ink sign them and send them back. But most people these days, it's DocuSign. You basically just click a button, go through the disclosures, and they come right back to us. Once that is done, because in those disclosures is number one, there's a full loan estimate in there, which talks about all the costs that we've already probably gone over by now. And there's what's called an intent to proceed. We cannot move forward on your loan until you sign that intent to proceed. Basically, you're acknowledging on moving forward. Once we have those disclosures back, the loan then goes to our processing department. And everyone, Univest is such a tight, the loan department is such a tight knit community. We're all constantly working together daily. I mean, we talk to our processors 10 times a day. So we work as a team. So, we do warm handoffs. We let you know you're going to be working with myself, my processor so-and-so, and my assistant, and whoever the case may be. The only person that you wouldn't talk to during the process would be an underwriter, in most cases. So the loan processor is assigned to the account, provides continuous updates throughout the process. Anytime a processor gives you an update, they are including us on those updates. So you're not calling me or Susan and saying, what's Michelle talking about? I don't even know what this means. We're all included on the emails, so we all know at all times what's being asked for. And that way I know if I need to pick up the phone and call you and explain something because it looks a little convoluted, I'm going to go ahead and do that. Again, then after processing, the processor submits it to the underwriting team. The underwriter is basically just spot checking everything, crossing T's, dotting I's, looking at the pay stubs, calculating the income, making sure we did it correctly, making sure there's nothing that jumps out that they might have a question about. They review the appraisal report that comes in prior to you getting a copy. They review it, make sure it's up, it looks up to speed. It's, the value is what I said it is for the house. There might be repairs that are needed on the house to qualify for the loan, such as a hand railing needed as a safety issue or something like that. But these are all things that an underwriter is going to look for. All of our underwriters are in-house, so things happen quickly. I would say this whole process that I'm going through, I mean, from you e-signing the disclosures and getting it through to underwriting can be as quickly as 24 to 48 hours. It can go pretty quick. So once the underwriter approves everything and we get final approval on your loan, then the loan gets handed off to our closing department. Our closing department is now your job is pretty much done at this point. Now the closing department is just going to finalize all the figures with the title company. At least it says 2 days prior to closing here. We probably do it farther in advance than that because we like to tell our borrowers, 5, 6, 7 days prior to closing, hey, here's how much you're going to need for closing, so on and so forth. Tell you who to get the cashier's check made out to. But this is what our closing department does. They basically finalize everything with the title company. We let you know, okay, we're all set for settlement on Friday. Please bring your photo ID, bring a cashier's check payable to the title company for $5,000. And, we see you at the closing table and we go through all the closing documents. And then Univest obviously funds the loan. We send the money to the title company and then we fund the loan. And everyone gets their key, you get your keys, everyone else gets their money, seller gets their money, and you're a happy homeowner. I know we got a couple questions in here. Let me just see.
Yeah, looks like some came through.
Yeah, let's see here. So from Kyle, where can I find if my loan will qualify for a rural opposed to FHA? And does one loan typically have better interest rates, or is that an entirely based around 5Cs? That's a great question, Kyle.
Yeah.
Susie, you want to take that one?
Sure. I mean, yeah, great question. And I always say when we get introduced to the borrower, the first starting point is getting basic information, running credit, and capturing that credit score, because that is going to be a good driving factor as to what program's going to be best for you. And then we will take and look at the USDA loan as opposed to FHA, and we can offer a side-by-side comparison. The government loan, the interest rates are they have better rates one versus the other? I would say they're pretty close, and a lot again is driven by credit score. So our job is to put you into the right product, and again, we can look at both of them to see if they're a good fit for you. And I think, Kyle, you also asked, would it be wise to shop around multiple pre-approvals, or are all banks generally the same? So like a really great question as well. Mike, do you want to chime in? Do you want me to answer?
Yeah.
It's totally up to you.
No, absolutely. I'll chime in real quick. Kyle, both of these are great questions.
Mhm.
So what I would tell people is listen, you as a consumer obviously have the right to shop around. The key things you want to look for is not just interest rate. So people always say, well, what's your rate? What's your rate? What's your rate? Because that's what they're embedded to ask. There's so much more that goes into a mortgage and financing needs than an interest rate. Okay, things. What are the costs? People say, well, this bank offered me, X interest rate. I'm like, okay, did they give you a cost estimate? No. Well, okay, you should start with a cost estimate and compare the two that, mine and theirs that you're offering, because they might be charging a lot more fees to get that interest rate. And a lot of times, unfortunately, that's the case. But then there's other things like servicing. For example, Univest, we service the loans that we close. So I always tell clients, listen, I'm going to be here through the process. Now, when you have a question, you get a piece of mail, I'm going to get you the answer. A lot of times,
Mhm.
what will happen is lenders will close the loan, they don't service it, your loan gets sold off, and now you don't even know who you're making your first mortgage payment to. So not only you find out a couple weeks later when you get a letter in the mail that your loan's been sold, you have no relationship with anybody. So you got to look at all different factors, not just the interest rate when it goes into it. But to circle back to your question, what I tell people is if they do want to shop around and get quotes, I provide, if I do their pre-qualification, which involves a credit check, and I give them an estimate, I tell them what their credit score is. And if they say, well, they want to shop around, they can get quotes from other lenders without having a lender have to pull their credit. I highly suggest not getting your credit pulled over and over and over again. If they can call the other lender and say, I've already been pre-qualified, I've already been pre-approved, my credit score is 735. Here's the parameters that I'm looking for. Can you work me up an estimate? And they can absolutely do it without pulling your credit.
I see another question here, Mike, and it's a two-parter, so I can answer one and you can take one if you want from Ellie. Um, she says, if you don't have reliable income, either because you haven't been in your job very long or because your income isn't salary based and is variable, what can you do about that? That's a really good question. Is there an option to have someone with more reliable credit co-sign with you? That's a fantastic question. So just because if someone's not salary doesn't mean we're going to say there's no hope or you can't get a loan. We when we're having that initial conversation and we're looking at all your income, we're going to try to figure out, are you hourly, are you salary, are you variable, are you self-employed? And we're going to try, like, with especially with it being a variable income, we're going to average your 2-year history. So we'd like to see a 2-year history, a job history. Um, if it's to the point where it's like, well, we need a little bit more income, then yes, we can look to get like a non-occupying co-bar, someone that's going to co-sign with you to bring on more income to help support the ability to pay the loan. So that's a great question, and we'll help guide you once we evaluate your income, and then we can see what options we have. And the other one that you had, which was really good too, is what if you want to buy a condemned house or otherwise really messed up house to fix? And Mike can touch base if it's okay, Mike, if you want to go over maybe renovation loans, I guess,
Sure.
if you want to. Okay.
Absolutely. So we do offer a purchase and renovate product for somebody who wants to buy a primary residence. We do not offer it for somebody who wants to buy an investment property and fix it up and rent it out. It's strictly for somebody who wants to buy it up and live there. But if you want to buy a property that's in need of a lot of work, we can do that, and it works similar to our construction to perm, except you're not building a house from the ground up. Here, the definition of a renovation loan is there has to be a structure. So there has to be at least call it sticks. So, there has to be some sort of structure on the foundation. If it's just a concrete slab, no, that's going to be a construction loan. But you want to buy a property that's fully dilapidated and spend $50,000, $100,000 to fix it up, we can definitely do something like that.
I don't see any other questions. Do you?
I
Someone
do
raised their
not.
hand. All right. I see a hand raised by Juliet. Juliet, do you have a question we can help answer?
I have a question regarding like, the debt to income ratio. Is that still based on the gross income of a person, not post-tax?
It's a great question. It is. It's great. It's based on, so when we calculate debt to income ratios, it's based on your gross income, not your net. It's a great
Okay,
question.
thank you. And you mentioned it was like you can 45% or less is best, and then you can go up to 50, but it's best to keep it 45% or less for that.
It's ideal. Yeah. And again, it all goes back to risk. It all goes back to
Right.
risk. So yeah, I mean, ideally you want to stay under 45%. We do have the ability to go up to 50. As long as there's other compensating factors, we can do that. It's just a matter of, and again, every loan is going to be a case by case basis,
Right.
but
I understand. Thank you. And in terms of the credit card debt that's on there, is that just if it's a revolving debt, but if I pay my credit card like every month, then it won't show up on there?
so when we go to pull your credit, it's going to, whatever's showing up. So revolving credit cards, installment loans, such as cars, student loans. But if you have a credit card that you pay down to zero every month,
Right.
it really is just going to be a matter of the timing of when we pull your credit
Okay.
versus when that payment's posted and what the balance is.
Okay.
Yeah,
thank
just like a snapshot of your credit at that time. Yep.
Okay.
Good
Yes,
question.
Thank you. And then and then you mentioned that your fee is $8.95 and that's like a flat fee. Is that just basically the only fee that Univest has as part of the process, or are there other fees usually as well? Just from the Univest side. Obviously there's title, insurance, all that other
Yeah.
stuff.
Yep. So we have our flat fee, our flat origination fee is $8.95. So the only other time you would have costs from Univest is if the interest rate, like the interest rate and the points go hand in hand. So if you wanted to buy your interest rate down and pay points to get a lower rate, that gets lumped into the origination charges, but that's an option you can choose to do or not. The flat fee is the $8.95.
Okay, thank you. And then in this market that we're in currently and we were in, is it best if you can get a conventional loan to go with the conventional one? So, or is it the stress just isn't as much of an issue for FHA or any of the other ones?
No, I mean, and again, it all goes back to case by case, like what's the best
Okay.
product for you based on your credit
Okay.
criteria, your income. I mean, we do a ton of FHA loans, we do a ton of conventional loans, we do a ton of VA and USDA. It really comes down
Okay.
to what best suits your particular situation.
Okay, thank you. And so if let's just say hypothetically, I get go through the pre-qualification process, everything seems fine, and I'm ready to make an offer, but I want to make the offer basically like on a Saturday or Sunday, just because I want to get it to the seller. Is it a pretty quick turnaround time to get an official letter at that point?
Yeah, I can tell you that we have the furthest thing from a 9 to 5 job.
Yeah.
We're almost on call because you got to think, when are people looking at homes? They're looking at homes in the
Right.
evening hours and they're looking at homes on the weekends. So if we're not available, we don't make ourselves available, we know that you're just going to go to somebody else.
Okay, thank you.
Mhm.
And my only other question is like, do you have any special rates or any incentives if someone already has a Univest account, or is there really nothing there for current Univest account
That's
holders?
another great question. So we do offer on some programs, we do offer a slight rate discount, whether it's an eighth of a point or a quarter of a point off, depending on whether it's a portfolio loan, under our adjustable rate programs, or on the home equity side, we'll offer a quarter of a point off the interest rate. But it is if the customer is a Univest account holder and they tie the loan to that account, like ACH, automatic payments from that account.
Okay.
So there are different scenarios where you could potentially get a slight discount on the rate for having a Univest account.
Okay, thank you.
Mhm.
I think that's about it. Thank you.
And then there's a couple more questions that came. You're welcome.
I think Kate had, is the insurance on FHA going to raise monthly cost to the point where it'd be better to just wait until you have a whole 20% to put down on a conventional loan? Is PMI tax deductible? I mean, I would say for this question, this is great, Kate. I appreciate you asking this question. So some people always ask like, oh, should I go FHA? Should I do conventional? Again, the starting point is running credit. If we're seeing credit scores on a little bit of the lower side, it actually might make more sense for a better rate to go FHA, and especially if you have a little bit less funds to put down, versus waiting and waiting and waiting till you're getting that full 20%. As far as PMI tax deductible, I mean, I'm not a tax accountant. I don't know, Mike, if you want to answer that, but I don't know how to answer
Yeah.
that part.
I always tell people when they start asking tax questions, I mean, they're great questions, but I never want to give anybody incorrect information when it comes to tax advice. All I can tell you is, your mortgage interest that you pay is tax deductible. When it comes to the PMI, I mean, that's something that you'd have to consult your tax advisor to see what exactly you're able to write off. And again, there's different tax brackets, different levels of what you can write off. So I always tell people I don't try to be an accountant. I don't play one on TV. So I'll stick with what we know.
Right.
There was another question. How does Univest calculate PMI from Kyle? Another great question. So the one benefit that I love about Univest that I didn't have at a previous employer that I was at for a long time, we actually get to shop your PMI for you. We use 6 different PMI companies. So when we run your loan scenario through, and if it needs to have PMI on it because you're not at the 20%, we can shop that for you. So we can actually get the cheapest quote for you on the mortgage insurance. You got to remember, PMI is also, private mortgage insurance is also based on risk. So it's based on credit scores. It's based on debt to income ratios. It's based on how much you're putting down. PMI is going to be higher for somebody who's putting 3% down versus somebody who's putting 10% down. There's so many different variables that go into calculating how the companies come up with what your PMI rate is. But I will tell you that those are the main factors. And a big one, obviously, is your credit.
Mm-hmm. Go through. I don't know if I see any other questions.
Yes, I don't see any more.
No. In a few minutes, but I want to make sure we don't miss anybody. But I think we got them all.
And if you want to go, Susan, if you want to just go to the last, here's our contact information.
Mm-hmm.
If you guys just want to jot down, if you ever need to get a hold of us for any other follow-up questions or any needs, anything you need, please reach out to Susan or myself. We're happy to help.
Yep, definitely. We appreciate everybody coming. It's a lot of fun to talk about mortgages and to share some information to help you, gain some knowledge. But again, yeah, ever down the road, if you want to reach out to us, we'll be happy to help you one by one. And thank you so much for participating this evening. I guess that might be it, huh, Mike?
Yeah, thank you, everybody. Again, if you have any follow-up questions, please feel free to reach out to us, cell phone, email. You see our websites there, and then look forward to follow-ups. And I appreciate Susan. Great job. I appreciate everything.
Yeah, thank you so much. Have a great evening. All right, take care.
Thank you, everybody.
Bye-bye.